Thank you for joining us. Welcome. Today, we're going to talk about retirement planning. And by taking the time to attend today, you really have taken a very important step towards a brighter future for you tomorrow. And if you have employees, perhaps for your employees, retirement planning has just been a long ignored topic throughout the country, not just childcare. As a in the country, we don't talk about it as much as we really should. So, in all different sectors, retirement is something that doesn't get brought up as often and discussed as often as it should. We know childcare providers put everyone else first before themselves. You work incredibly hard, and we're afraid that you're going to find yourself with very little retirement savings because you are so busy with everything happening now. So let's change that starting today, right? Let's see if you can learn some things. We'll give you some information that you can take and help you into the future. And I always say, if you can, also share what we talk about today with anyone else in your personal life, and especially if you know anybody young so that they can get a nice jump start there. And of course, as always, we want to thank DECAL for having us here today. We've been working with childcare providers in Georgia through DECAL for many years now. We just love being able to do this. So, and also just keep in mind, in addition to webinars, we do one-on-one coaching through DECAL, and we also do some group coaching. So we'll be sharing a link at the end that you can use to join us there. We'd love to have you. All right. Quick disclaimer that the information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing the information, but does not guarantee its adequacy, currency, completeness, accuracy, completeness, adequacy, or currency. I tried to do it by heart, or currency. The publication and distribution of this information are not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information and the recording of the content, including the use of AI, are expressly prohibited. Only non-commercial uses of the work are permitted. We will be taking this recording and sharing it on our YouTube channel, and the DECAL, the Thriving Childcare Business website, will also have the link so that if you'd like to see the recording later on, you'll be able to. All right. We know, right? Retirement planning, so important for you, so important for employees if you have any. And we're going to talk first about your personal retirement needs. I want you to think through that before we start to think about retirement plans through the business. So we're going to talk about that, and then we're going to walk through some options. We're going to see what retirement plan may be right for you. Retirement planning, how it benefits employees if you do have them, and by benefiting employees, it benefits your business. And then how can you increase your savings? Just a couple little tips to help you increase your retirement savings. Do that there. All right. So we know one of the most important decisions that you can make in your life is the planning for retirement. No, absolutely no doubt about it. And these are the reasons. You deserve security. You worked very hard all of your lives, and retirement should be the time to live the life that you dreamed of after you stop working, or maybe stop working full time. And that's different for everyone, right? Not everybody has the same picture of retirement, but we all are going to need, in most instances, to supplement our Social Security. We'll talk about that. So we really want to make sure that you have control, peace of mind, wonderful future. As far as your business is concerned, there are some really great tax advantages to opening retirement plans through the business. And then with your employees, boy, it shows that you care. It's a great method of recruitment. It's a great method of retention. I've got retirement on the brain, of retention. So these really are the way. How does it affect you? How does it affect your business? How does it affect your employees? So, as I mentioned, we know as business owners that you put everyone else first. You put your families first, the children first, the team. But planning for retirement, it's not selfish. It's how you care for yourself. So let's take a look at a few reasons why planning and prioritizing your retirement is really, really important, even with everything that you have going on. Right? So we know that there. So it's hard, but the responsibility of retirement planning does fall solely on the individual. It falls on us, on all of us. And we know that there may be Social Security payments. You may receive Social Security in the future, but we'll go over and explain why Social Security can supplement, but it may not be enough to cover all of your expenses when you retire, right? So planning for your retirement is the personal decision, and you take it really seriously, right? So by putting those needs first, your retirement needs first, you really are preparing for what could be and unpredictable, could have unpredictable events in the future, right? The future, we don't all know what the future holds, but we want to set each other up for success in the face of any challenges, or really to have a wonderful retirement that you obviously have worked hard for and deserve. So I do want to stress that the best time to start retirement is now. The sooner that you start savings for retirement, the more you can take advantage of what's called compound interest. We're going to talk about that in just a few slides. Compound interest is a wonderful way to see your retirement investments grow over time. But I will say, if you haven't saved before, just start now. Okay, now is always, it's a good time. Don't let yourself get overwhelmed by the idea that perhaps you're a little, you're a little older than you would have liked to be when you started your retirement savings. That doesn't make a difference. Okay, we're just going to think about starting today. So what's happened now in the world in which we currently are in, as of now, retirement looks very different than it may have in the past. All right, there's now more urgency to save for retirement than there was a couple of decades ago. So these are some reasons why it's really important, right? Why things are different now than they may have been in the past. So we're very, very fortunate that people are living longer now. There's longer life expectancy, and that's because we've got better healthcare standards than we did before, living standards. But what does it mean? Well, we're going to need more income because we're going to live longer, right? So we are going to need more income for additional years that previous generations may not have had. So, all right, we're going to live longer than other generations, hopefully, knock on wood. And then inflation, right? So inflation and the cost of healthcare will continue to rise throughout the time that you reach retirement and throughout your retirement, which is why we're looking to really maximize your retirement savings. And when there's inflation, right, your purchasing power goes down. So a good retirement plan really can help you with the situation of inflation, as well as rising medical costs, because what it costs right now for healthcare will most likely be more going into the future. So very, very important there. And we want everybody to think about, your lifestyle, your desired lifestyle. A lot of people, the goal usually is to maintain the lifestyle that you had while you were working. And a retirement plan does provide you with the savings and the income to do things like that in case you want to travel, if you have hobbies. We want everybody to feel independent, right? That they don't have to worry and rely on anybody else for financial support in their retirement. Great reasons, right? To make this the week that you begin. It's Friday. It's Friday. Take over the weekend. I'm going to share at the very end. There's a question and answer portion. If you are here with us live, I'm going to put some links in the chat that can help you can look into and move forward in some of that retirement planning. So here's the weekend for a little bit of research. All right. So what a major question that a lot of people have is, well, how much money am I going to need in retirement? What is that going to look like? And we know that that's on everyone's minds as they get closer to retirement age, but let's talk about a realistic picture now. All right. That's the plan, right? If we have a good idea what we're going to need, we can be ready when the time for retirement comes there. And this is also important, like I said, share with others, because sometimes this is a big surprise to individuals. And what has been found throughout the country, this is a very common figure, is that financial experts do estimate that most individuals are going to need up to and around 80% of their pre-retirement income to maintain the standard of living that you have now. So to maintain that standard of living once you stop working, you need to be able on an annual basis to receive from your retirement combined with Social Security 80% of what you are making now. That's the number we like everybody to think about. So if someone was making $35,000 now, they're going to need to make sure that they can pay themselves $28,000 a year. That's their retirement plus Social Security. Social Security on average is a little unknown, but the average benefit paid is $14,000 a year. So, and that is based on a lot of different factors. We're going to look at how Social Security is calculated, but that's a big gap, right? If somebody we know needs $28,000 a year and they're only receiving $14,000 a year in Social Security, how are they going to make that up, right? That's only half of what they're going to need. So we want to stop and think about that. And let's talk about compound interest. All right. So compound interest is where your money makes money on top of money. It's basically interest making money and growing interest, growing upon interest, right? Which is it's all about growth. So I'd like to talk to you about compound interest because it is how you boost your retirement savings. It's how you help your money grow to what you're going to need to meet that 80%. So we're going to look at compound interest. I'm going to throw out some numbers for you. These numbers are from a few years ago because we actually now, knock on wood, we have a slightly higher average rate of return on investments, but we're going to use this just as an example, right? So this is how your money grows using the benefit of compound interest. So let's say you decided to cut some costs and you have $50 that you're going to put into your retirement savings. All right, great. We're going to put that in there. And we're going to say for this example that you had 6.5% interest rate. Historically, it has been higher, but let's use that for right now. That was the average in 2022. So the first year, if you had $50 and you only put $50 a month into retirement savings, maybe you got DoorDash one less time and you put $50 into your retirement savings. Over that first year, you'd save $600. Okay, you made $18.20 in interest. And you say, okay, $618.20, right? Well, next year, you're going to put in another $618, right? So basically, well, it's going to be even more than that because the interest will grow upon interest. So basically what happens is at the end of next year, you would have about little over $1,200 or close to $1,300. Over 30 years, you save $18,000 yourself. Interest, growing interest upon interest, would be over $37,000. And that means that $18,000 investment over 30 years actually would grow with that 6.5% interest rate to $55,000, little over 55. So you invested $18,000, you let it grow, you kept investing. $50 a month. It ended up in 30 years, it was $18,000. The result, should the market hold at 6.5%, is $55,000. That's pretty nice for $18,000, right? Power of compound interest. That's only $50. Imagine what it can be when you really stop and think and make the commitment as to what you can contribute to your own retirement plan. So, we mentioned that you will need 80%, or estimated that you'll need 80% of your income. And that now that you've seen compound interest, you have a pretty good understanding about why you want to start as early as you possibly can because of that growth upon growth, interest growing upon interest, boom. So the earlier you start, the better. Compound interest, really the power of time with compound interest is amazing. But if you are older than we say maybe 25 would be the average, the great year to start saving for retirement. I say as soon as someone gets their first job. I did not do that. But basically, even if you're older, you can still work towards establishing it because of compound interest. You can still make some adjustments to your budget. All right. So Social Security is what comes into play a lot. A lot of people, you think that they're going to rely on Social Security. And we just looked at that example of somebody who's going to need $28,000, but is on average only going to receive a little over $14,000 a year. So Social Security, that portion towards your retirement, knock on wood, is hopefully going to be there. But it does depend on how much you've basically contributed through Social Security or through Social Security payments or through Social Security. Your self-employment tax has a piece if you are a sole proprietor or a single member LLC. If you have been paying yourself via W-2 wages your entire working years, whatever that combination may be, you are paying towards Social Security. Let's take a look at what Social Security impact actually is. So basically, we know it's going to play a role in your future, but it is funded by the taxes that you pay, either now or in the past, through your paycheck, or for self-employed providers through that self-employment tax rate, 15.3% self-employment tax if you are a sole proprietor or a single member LLC, and a portion of that goes towards, that is considered to be Social Security tax. We hear a lot of things about Social Security running out. There's a lot of, oh my goodness, what's going to happen? It may be adjusted over time. There will be tweaks, but it is extremely unlikely to go away. Of course, we don't know the future, right? But this Social Security is really, really embedded in the financial picture of the United States. Almost 90%, close to 90% of retirees do really, they really rely on a portion of Social Security. So we do understand, we should understand it's going to be there, but probably not exactly the way that it is. So we want to factor it in. We want to think that there may be some changes, but even partial benefits can make a really big, big difference. So in this country, as you pay towards Social Security through tax withholdings, it's a pay as you go, and your benefit is going to depend on how much income you report. We'll talk about what those years look like, how many years you report, and when you are going to start collecting benefits, because everybody gets a number in their head. For instance, I can start to collect benefits at 62. We're going to talk about why that may not be the best strategy for you. And I say may not, because that can change for everybody. So here are the options, and this is where that 62, being 62 years old, sometimes people don't consider what impact that could have if they started taking their Social Security at 62. So what happens is that you earn what we'll talk about. You earn credits based on the number of years you've worked, the amount of money that you have paid into Social Security. If you were to take your Social Security benefit at 62, between 62 and 66, 66 now, or I should say 67, is now considered to be the full retirement age. So if we took our Social Security between 62 and 66, we actually only get somewhere between 70 to 75%. It increases as you get each year as you get older. You only receive that percentage of your full benefits, and that is for the rest of time that you receive Social Security. It doesn't change when you hit 67. You start to claim 62 to 66, it's going to stay between 70 and 75% of what would have been your full benefit. If you start claiming benefits between 67 and 69, and this can change a little bit throughout different administrations, but right now, 67, 69, 100% of the benefits. So 25 to 30% we would be giving up if we retired and started to claim our started to receive our Social Security benefits between the ages of 62 and 66. But 67 to 69, the full benefit that we've always worked for. Again, for the rest of time that we receive Social Security. If you delay until the age of 70 or over, your benefits actually can increase to up to 132% of what you would have received if you started to claim benefits between 67 and 69. So look at the big plus to retiring, starting to claim your benefits. I shouldn't say retiring is the same as taking Social Security benefits, but when you start to receive benefits, if you were to receive them from 70 or later, there is a large financial impact, and that is received for the rest of the time that you receive Social Security for the rest of your life. So I get concerned when people start to talk about that 62 to 66, that retirement period, only because you are not going to be able to get the full amount that you are entitled to of your Social Security benefit. So I know so many of us say, oh, 62, that looks a heck of a lot better than 67. Oh my goodness. But it can have a huge impact over the remainder of your lifetime. So keeping that in mind there. So sometimes people think that there is a mystery as to how the credits are calculated, and there isn't. It is pretty, it is written in stone. Okay. So the amount that you're going to be earning for Social Security, that you're going to be taking, receiving the distribution, receiving your Social Security payments are based on credits, the amount of credits that you earn. And just so that you know, at the end, I'm going to share the link to the Social Security website. There you have your own account. If you have it, you may have it already, or you're going to open an account, and then you're going to be able to see year after year your estimated Social Security benefits at each of those time periods. They're created and calculated based on this formula. All right, so you receive a credit for every year that you have claimed, either received via W-2 or claimed on your Schedule C, anything greater than $1,640, you earn a credit. All right. That 1 year of work basically will add up to four credits, and you have to have at least 10 years of work, which basically over 10 years of work, to be able to qualify to receive some Social Security. All right. So when you think about that, so Social Security, they don't take every single year the same. So every single year does not get you up to the four credits, or is not less than the 4 credits. What Social Security does is by the time that you claim a benefit, it looks at your highest earning years over 35 years. So if we were to work 50, our Social Security benefit is based on 35 highest income years. That, combined with the retirement age, is how your benefit ends up being calculated, right? So we know 62 to 66 is one percentage and so on. But basically what you have to think about is that you earn a credit for the $1,640 up to 4 credits a year. And those credits basically combined with the amount of money that you made and the age in which you start to receive your benefits, that is what determines what your benefit is going to be. All right. So we have an example here. This is a Schedule C. So if you're a sole proprietor or a single member LLC, you're very familiar with this. We're just going to start with this particular, we're going to start here with this form just to show you why line 31 of a Schedule C is very, very important. So we know to earn 1 credit, your earnings need to be at least $1,640. And you have to have a year of credits, 4 credits, in order to start to qualify for Social Security. So that's 1,640 times 4. So your annual wages need to be at least $6,560. You get those four credits, right? So you have to show a minimum income on your Schedule C of at least $6,560 to receive the 4 annual credits. All right. And we know that we're always talking, we coach on taxes, just so you know, in DECAL, we have group coaching for centers and family child care. We have one-on-one coaching on taxes. So we're always happy to talk to anybody about their particular tax picture. But what do we do in tax when we talk about taxes, right? We're always talking about every single allowable deduction. And I'm a big believer. You are a business owner and you're able to take allowable deductions. Those are the laws as far as the IRS and taxes are concerned. Just keep in mind, the lower your profit, the lower your Social Security credits, because your credits are based on the amount of money that you report every year, right? The amount of credits you can take, the amount of income you report directly tied to that. We don't want you to overpay taxes for your business. Absolutely not. But what we would love for you to do is to think about striking a smart balance. If you're curious about if you've been reporting that $6,560 net income a year, look at your old tax returns. All right. So on your Schedule C, you're going to see that. You're going to see that on if you're an S Corp or a LLC electing to file as an S corporation, you'll find it on your 1120S. Take a look at that. Take a look and see what your net income has been to give you an idea. But the beauty is you're also going to be able to go to the Social Security website and take a look. All right. So the Social Security website, and here is a QR code, but I'm going to put the link in the chat as well. This is where you can see what your estimated benefits are. It talks about all those different ages. It looks at your whole earnings record. So you get to see what has been reported to the IRS as income, which then reported to Social Security to earn those credits. You get to see what you've paid over your working career. They're looking at the highest 35 years, right? So they're taking a look at that. And if you look at the statement every single year, it will give you a very accurate picture right up to the time of retirement. They usually send you a statement, or once you're enrolled, you can receive an email every single year to show you where you are. And it's usually around your birthday. I think it's like a month after your birthday or somewhere there. But I always recommend optioning also for online. Maybe you don't receive the paper. I personally still receive the paper, but getting online and looking at this on a regular basis. So, okay, what are the next steps that you're going to take? Well, the best way to reach your retirement goals is to think about 10 to 15% of your annual salary. So that could be if you are working for an employer, and I know most of the individuals here are business owners, but could also be directors. If your company is giving you any type of match towards in a 401k, great, you can include that in that 10 to 15%. But keeping in mind, right, the more you contribute, the better off you're going to be. Not everybody can start with 10 to 15%. You start where you are. If there is a match in your company has a 401k plan, don't leave that match on the table, meaning at least contribute up to that match percentage, because that's pretty much free money for you, right? So if your company says we match up to 3% of your income, of your salary, definitely contribute at least 3% because they're going to match that 3%. So keep that in mind, but just keep putting money away. And wherever you are, aim to increase it at least 1% every single year. So come the end of December, January, if I was contributing 15%, next year, I'm going to contribute 16%. The year after that, 17%. Those little increments are not as noticeable in the long run. Basically, you're going to be building and not feel as much of an impact, right? We do always recommend if you can do an automatic deposit, and you don't have to be paying into a 401k to do this. If, as a single member LLC or sole proprietor, you can set up a retirement plan through the business, automatic deposits. You would work with an organization, a financial institution like Fidelity, Vanguard, Charles Schwab, and they can just do automatic withdrawal for deposit into your retirement. Fantastic. Set it and forget it, right? We absolutely love it. There's those gradual increases, 1 to 2% a year. Just keep putting it in there. If you also have, there are retirement plans set up through the business, whether you are an employee or a business owner, we're going to talk about that, but you also can have your own retirement plans set up so that the two, we'll talk about that mix, but whenever you get some extra money, put it into retirement. You got a great tax return. You received something that you hadn't thought about. You paid off the car. Oh my goodness, now there's an amount every single month that you could increase for your retirement savings, right? Thinking about that. If you increase your tuition, and we want you to look at your tuition, right, every single year. If you increase your tuition, maybe there's a portion of that that you could automatically be putting towards retirement. So catch-up contributions, and they change every single year. But what is a catch-up contribution? Well, you are allowed from the age of 50 or older to contribute more every year because every retirement plan has a maximum of amount that you can contribute. So it's not as if we can contribute millions of dollars. There's maximums for each different plan. Each one is different. A retirement specialist can explain to you what that looks like, but all retirement plans are set up. If you are over the age of 50, you would be able to contribute more to a retirement plan. It has a higher maximum, right? So you can contribute more than if you're under 50. We call it catch-up contributions because maybe you didn't have the opportunity to max out your retirement plan or to pay as much into your retirement plan as you would like. Catch-up contributions can help you in those last 15 to 20 years of working there. So pre-tax, post-tax, a lot of times we think about it in terms of age. Which one would be better to have? There's two different tax strategies. We like a good combination, all right? So if you're considered to be younger, let's say 40 or younger, a post-tax mixes. So basically, being able to have these two vehicles together makes a lot of sense. You have a lot of compound interest coming for you. You're younger, right? So you're going to be growing that. A pre-tax mix, what is that? Well, that basically is something that you are contributing to through the business. If you own your business, you can set up retirement plans through the business. You contribute to your retirement plan. If you have employees, to your retirement plan and to the retirement of your employees. And you also are able to take those as business deductions. Absolutely wonderful. That is what's called a pre-tax retirement plan because it comes out of everything before you've paid taxes on it. 401ks, SEP IRAs, you're going to see all of those are what are called pre-tax. Post-tax is when you open a retirement vehicle outside of a business and you've already paid taxes on that income. You've already paid, taxes have been paid. So the money that you're putting into that is growing year after year, tax-free. SEP IRA, 401k, we contribute before we pay taxes, and we pay taxes on it when we take the money out, distributions. And that's pre and post. I apologize, I think I just messed those up. But post-tax is when we have already paid taxes on something, put it into retirement, and when we retire, all that money gained by compound interest, we get to take distributions and not pay taxes. It all grows tax-free. So I think you can see how mixing those two would be a really, really good strategy. Individuals under the age of 40, we usually would say, hey, why don't you max out the post-tax first and then work on the pre-tax. And what's the reason for that? You have more years that can grow tax-free. But this is not something where if you're over the age of 40, you shouldn't think about the post-tax. This is a very nice mix. And I'm an educator when it comes to taxes and retirement. I am not a financial planner. Civitas, we do not offer financial planning advice. But when you meet with a financial planner, they're most likely going to talk to you about that kind of mix. All right. Now, there are other ways of savings towards retirement there. I have a little quote in my notes, and this is from Warren Buffett, right? He's one of the most successful investors in the United States. And he said, if investing is entertaining, if you're having fun, you're probably not making either any money or as much money as you can. Good investing is boring. So, what does that mean? Putting money aside on a regular basis, ongoing, putting it there. There are ways that money can be invested through mutual funds, through exchange traded funds. That's what financial experts will help you with. Financial experts will help you with what should that look like, right? They help you manage. What they do is they look at your estimated retirement date and they figure out what is the best mix of investments. When you're younger, usually it's more aggressive because if something were to go down, go up, go down. You have longer time. As you get closer to retirement, they start to put you in with a mix that is more conservative because we have less time to ride the changes there. That is what a retirement planner, financial advisor can help you with. That is actually what they will do there. So what should you know? Remember special treatments for taxes. Well, we have pre-tax 401ks, sub IRAs. We have Roth IRAs that we can put money into, having already paid taxes on. Fantastic. Keep in mind that there are penalties and taxes really, really large for withdrawing before the age of 59 and a half. There are also a lot of negatives to taking loans from retirement plans. I hear it all the time. People will say, oh, I took a loan to do this, I took a loan to do that. What happens is, yes, they're paying themselves back. Great. But compound interest, right? Over time, we've lowered the amount of money that can compound over time. Yeah, we're eventually paying that back, but we're losing that, having that right from the beginning. So please be very careful if you are thinking of taking a loan against a retirement plan. Just kind of think it out and see what it could cost you in terms of losing out on compound interest. There are, in many instances, hardship allowances. Just so that you know, I should go back and just to say what are those penalties? Well, the penalties, if you pull some money out before 59 and a half, 10% penalty for some types of tax plans, retirement plans, excuse me, 25% if you've just started contributing for some retirement plans. So you are going to have to pay taxes now on what you received, and you're going to pay penalties. So that's another reason why we don't withdraw before 59 and a half. If you were to have hardships, there are some plans that allow for if you have unexpected medical expenses that aren't going to be reimbursed. There's a certain percentage that you could take out of your retirement and not pay penalties. Medical insurance, if you're unemployed, if you're disabled, some plans even let you take money out without being taxed or receiving penalties. I should say penalties, without receiving penalties. If you were using the funds for college or buying a first home, building a first home, please speak to a financial advisor before you make any of those decisions. So if you are a business owner or a sole proprietor, single member LLC, how can retirement planning help your business? Well, everything that you put towards your future and the future of your employees through the business, not the Roth IRA, but the plan, that is a deduction. That's a tax deduction. Fantastic. We know the tax favor. What we mean is we're putting money in before taxes are withheld. But what does that do? Well, that lowers our income for that year, and we pay less taxes on that. So we absolutely love that. Every retirement, remember, we want to get those tax credits, right? We want to continually hit that number. And if you're doing this with your employees, recruitment and retention, it's fantastic. Employees look for retirement plans as one of the benefits. All right. So even if it is just you, the expenses related to any expense related to, including the contributions you're making to your future, those are tax deductible for the business. So, and we talk about that they are tax favored. That's because the government does want they want to encourage you to save, right? So if it's using the pre-tax, fantastic. Post-tax, we know you're going to grow your funds um, without having to pay taxes when they're distributed, right? So just kind of keeping all of that in mind. Retirement, as we said, right? Those contributions get you tax credits for, assuming they get you Social Security credits, but they also get you tax credits. And what are tax credits? Well, there's what's called the savers credit and retirement plan startup cost. It can change per administration, but what it is it allows you basically to be able to, there's a savers credit that within certain income brackets, you actually can get a tax credit on your taxes. Not only did you put money aside, you get to take a tax credit, get a tax credit. We love tax credits because they're a dollar for dollar reduction of your taxes. So keeping that in mind there. And then there are also credits for the business for any of the costs that you have in addition to all of the contributions that you may have made. If there are costs associated with starting a retirement plan, there are several different ways to get tax credits for the business, lowering. They're dollar for dollar. You know, when you take a tax deduction, an expense, it lowers your taxes by a percentage. When you get a tax credit, it lowers it dollar for dollar. And I would love to speak to someone. In Georgia, we have a group that's maximizing tax credits. There's a portion of it that's just about Georgia. There's a portion of that group that's for federal tax credits. We talk to you about those types of things. So would love to see you there. Again, what do we say? And I know I'm talking a little fast because I'm running over. So basically, keeping in mind, employees do consider this to be a fantastic benefit. Keep current employees, right? Yeah, you're giving them this amazing benefit. Retain people. Put that in your marketing, your job announcements when you're hiring. Put in that you offer that benefit. You are then preparing for the future, helping your employees prepare for the future. That's really valuable. Employees do value that. Some of the recent studies, 93% of people who were polled said that a retirement plan is something they would consider a draw, that they would consider one of the reasons to take a position, one of the reasons to stay with a company. So really big impact there. So what I want to show everyone here is we're going to look at an example of sole proprietors with no employees. We're going to look at an example of businesses with employees, how tax credits, those dollar for dollar tax reductions can help. What does that really look like? So in this particular situation, Imani is a family childcare provider. She's a sole proprietor. Last year, she made $38,000. Great. She decided that and we know just for our calculations that her personal income tax rate is 12%. So everything we look at is based on this 12%. So she opened what's called a simple IRA through the business, and she made $2,000 in contributions over the course of that year. $2,000 towards her retirement through the business. Beautiful. All right. So that $2,000 gets saved over and over again because she's lowered her self-employment tax. She gets to take that $2,000 and she gets to take it as a business expense. Fantastic. That also lowered her income tax, right? If her final self-employment amount is less, it's also going to lower her income tax. So in this particular example, between the self-employment tax reduction in revenue because of self-employment and because of her income tax, she lowered her taxes by $546. The tax credit that we talked about for employees of making up to a certain amount, well, she qualifies for that savers credit. And that savers credit gets her 50% of her contribution, $1,000. So basically, she contributed $2,000 towards her retirement, but technically, she's the business owner. She gets to lower her taxes, her self-employment income, or pays less in self-employment taxes, pays less in income tax, gets the savers credit, only cost her $454 to put $2,000 towards her future. Contributions, deductions, lowering tax, getting credits, all comes together, there's a big impact there. Now, in this situation, this is Estelle. She has 15 employees, and she basically decided her business is an LLC, and she said, I'm starting a retirement plan for my business. She has a business that is declaring as an S corporation. And what that means is that the profit of the business goes over to her personal tax return. There is no self-employment tax. In our little estimation here, she's at the 22% income tax bracket. So what did she decide to do? Well, she is going to match. She's going to put 5% of the salary of each employee, 15 employees. She's going to contribute that through the business herself. Remember, that's a tax deduction. So in this instance, that's $1,560 per employee. So she contributed $23,400 towards her employee. All right. She had some expenses. She had to pay a bookkeeper. There's some money that she had to pay to create the 401k, which are expenses, right? She's taking those as deductions as well. And let's say that those cost her $2,550. All right, let's take that. Estelle paid a total of $25,950, but she saves money. 401k is brand new. There's a credit that lets her take 100% of the administration costs. So immediately, boop, that $2,550, it's as if she no longer paid it. She's going to get a credit for it, dollar for dollar. Her employees make less than $100,000. There's actually a credit for the business, not just for those employees, right? The savers credit. There's an employee where she gets $1,000 for her contribution per employee. $15,000 comes off of that. Tax credits, $17,550 in tax credits. Let's keep in mind, she paid $23,400 overall for her employees, right, $29,950, $17,550 just in tax credits. So she gets then to take deductions, right? She gets to take deductions because those are allowable business expenses. That saved her another $5,709. So her benefit cost her, we'll say, out of pocket $25,950. But because of the credits, because of the deductions, because of lowering everything, she actually ends up only spending $2,691. The credits, the tax savings, all of it was $23,259. Wow, she put that much money towards her employees. She had expenses, but through deductions, through tax credits, it actually only cost the business at the end of the day, the net amount, $2,691. And she was able to offer that great contribution for her employees. I know that we're running really short, and I'm going to share some links so that you'll be able to look at some things that we may not get into in depth, but most of the time, on average, 4.3% is what on average employers contribute to their employees' retirement. So just kind of keep that in mind. Look currently in your market. All right. Now, which retirement plan is right for you, your business, your employees? Let's take a look. You're going to see, I'm going to share a link for what we call a retirement tool, but it's actually an app. It's free. Civitas created it, and it will walk you through these scenarios. So this is not the only time that you're going to see it. What does it do? It divides up between people who don't have employees and then splits between, are they younger than 40? Are they over 40? And then businesses that have employees. What does that look like? There's 4 different scenarios that you'll see in the app. If it's just you or you and your spouse and you're under the age of 40, this is great. Roth IRAs, we talked about that, right? That's a post-tax contributions just keep growing. These are the 2025 numbers. I do apologize. Every year it changes, all right? So taking a look at how much, that's the maximum that somebody could contribute. 50, we said if you're 50 or over, you get those catch-up contributions. Roth IRAs, fantastic. SEP IRAs, those are the ones that are pre-tax. This would be a great option through the business as a single member LLC or a sole proprietor. Great. We start with the Roth, then we have the SEP IRA. There's what's called a solo 401k. What the benefit of that is just like a SEP, you're not taxed until you start withdrawals. You can contribute more. to a solo 401k. So that's why that may end up being attractive. Now, if you're over 40, right, 40 or over, we say start with the SEP. Okay, start with the pre-tax, because your earnings, we need to get them in and we need to get them compounding right away. And you'll pay the taxes at the time of retirement when you start to take those distributions. So, and you'll see there are contribution limits like all retirement plans. You also you can do a solo 401k as well. We mentioned that, higher contributions. Then we can start to think about a Roth IRA so that we've got a pre and post-tax mix. All right. Now, if you have employees, you have a couple options. Do you want to be able to vary the contribution for your employees every year? Or do you want to pay the same amount, contribute the same amount every year? SEP IRAs, also, we mentioned it for sole proprietors, single member LLCs, also available for employers. However, a SEP IRA is only an employer contribution. Your employee does not contribute anything. You set an amount and you make that contribution every single year. These are others, excuse me, let me just go back real quick here. Oh, vary, I apologize. There's another that you can vary. So I'm so sorry. You can contribute up to, I apologize. SEP IRA, you can contribute up to. There are plans where you can vary. The oh my goodness, the simple IRA is one where it's a set amount, but you choose one of two options. So either you choose that you're going to contribute 2% ongoing, or you're going to do a match 1% to 3%. You choose one of those options and you stick with it. So when you start the plan, you say, okay, I'm going to contribute 2% of an employee's salary regardless, or I'm going to match anywhere from 1 to 3%. And that 1 to 3% can change over years. So 1 year, you could contribute 1%. Next year, you could contribute 3, and go back to 2. So that does allow you to have a variable contribution there. 401ks, what everybody knows about, high contributions. You and your employees. Your employees can contribute a lot. You as the business owner can contribute a lot, but they can be expensive. They can take up time. And there's a lot of ongoing administration. Small businesses may not, and I say may not, you're going to speak to a financial professional, may not want to do a 401k plan. These are other things that retirement planners are going to speak to you about. Not anything that we're going to talk about today, but traditional IRAs, what's called Roth conversions, profit sharing, defined benefit plans. You may not have profit sharing, you may not have defined benefit plans, but those may be mentioned. How are you going to get started? Speak to people who work with financial planners, ask them for recommendations. Do some research yourself online. Look into, by all means, look into different types of financial planners. Read the customer reviews. What do people have to say about that particular either financial planner or financial institution? Like we said, Fidelity or Charles Schwab. We have no affiliation and no recommendation of one over the other, but you can do your research. Is it going to cost you money? What does that look like, right? When you are involved with something like Fidelity or Charles Schwab or other investment companies, you can sign up online, or you can, and with Fidelity, you actually can talk to somebody over the phone as well, but you can sign up online and never speak to a person. So they give you a lot of guidance along the way, or you could choose an accredited financial planner, right? They could help you, and that would be something usually in person. So you can do that. This is the link to the QR code for that app. That app goes over everything that we talked about in that flow chart. What plan is right for you, depending on your age, depending on your employees? Do you want to have a fixed contribution? That will help you. I'm going to put that link in the chat right now. So I know we only have 2 folks with us. I don't, let me just double check here. Everybody put their PDS number in there. Yep, so Maxine did. Okay, great. Thank you, Mary. Thank you so much. What I'm going to do in the chat is I'm going to put the Social Security website link. All right, go ahead and do that. Okay, The next link is for the app where we just saw that QR code. That is going to walk you through that decision chart. All right. The reason I have to do this, if I did this before you guys logged on, you can't see anything in the chat until only things after you've logged on. That's why I do it at the end here. All right. And then this next link takes you to, available in English and in Spanish, takes you to DECAL's Thriving Childcare Business Academy. And there are 3 different guides, part 1, 2, and 3, that basically are a deeper dive than what we talked about today. So you have those resources. Those are 3 different guides available in English and in Spanish. There also are short videos there. So when you pull up this page, you're going to see a little, looks like a little PDF symbol. That's the guide. And you're going to see a little camera that DECAL has made the videos. So if we have any questions, feel free to come off of mute. Feel free to put questions in the chat. I'm just jumping ahead just here while I wait for those, just to remind everybody that through the DECAL website, which is how you registered and came here today, you can sign up for all of our small study groups. Those are these 4 one-hour sessions on all these different topics. And now there's the maximizing tax credits for Georgia child care providers, for owners, directors, something that's called revenue stacking in Georgia, which is wonderful. It talks about bringing all sorts of things together to help you increase your revenue. Please go to tomcopelandblog.com. Tom, we are the stewards. Tom retired. Tom has run that blog for many, many years, and we have been running it now for a few. And I'm going to throw that in the chat there. It's really simple, right? tomcopelandblog.com. I apologize. I'm going to also look and see when our next webinar is. Right, Tom Copeland, making sure I have that correct. If you have any questions, over 1,500 different articles there, but there's also an Ask the Experts. You click on that, you can ask the question. So if we don't have any questions, if you would please, and I'm sorry we're running a little bit over, but this is a QR code. When you receive your PDS credit, you may also receive this link. I would love it for you to let us know about the webinar. What did you think about the content? If you have any questions? If we don't, then we are done. And I'm sorry I kept you 4 minutes over. So if anybody has anything, just happy to speak to you. Would love to see you in those small study groups. The same website that you got here today, that's where you register for coaching, for free coaching. Otherwise, we're done. So thank you so much.